The first atomic bomb was dropped on Hiroshima.
Over humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and effort that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Somewhere up there right now, the Artemis program is working through the steps to take humans back to the moon. From the outside, it looks simple. Big rocket, big countdown, big launch, slingshot past the moon, splashdown in the Pacific. But if you've ever watched Mission Control, you know that's not really how it works. It's really thousands of tiny course corrections. You launch on a path you think will get you there. Then reality shows up. Gravity tugs a little harder. A sensor reads a little off. A burn runs a second long, or a second short. Nobody panics. They adjust. They nudge their trajectory. And they keep checking. Are we still on course for the destination that actually matters? Your financial life is a lot like an Artemis mission. You set a plan. You retire at a certain age. You help kids with college. You give to causes that you care about. Then life throws its own gravity. Job changes, market swings, inflation surprises, health events, geopolitical turmoil. The mistake is thinking every wobble means that mission's failed, and it's time to hit the eject button. Going to cash, abandoning long-term allocations, chasing the next rocket ship to the moon. Instead, think like flight control. Keep the destination clear in mind. Expect the path to be messier than the diagrams. Make small and deliberate adjustments instead of wild swings. Let time and compounding do most of the heavy lifting. Artemis didn't get to the moon in one perfect move. It got there by committing to a destination and being disciplined about the corrections along the way. And yeah, your portfolio and your retirement plan, they should work the same way. After the break, I'm back with this week's history lesson for the modern investor.
This episode is sponsored by Victory Independent Planning. At VIP, our mission is simple. Live well, do good. We build strong relationships with good people and help them turn money into what really matters. Retiring without worry, traveling more, supporting family, or funding the causes and projects they care about most. Based in Naples, Florida, and Portland, Oregon, we serve clients nationwide with comprehensive fiduciary advice, retirement income planning, custom investment portfolios, tax strategy, healthcare and Medicare decisions, and estate and legacy planning, all carefully organized around your unique goals. If you're ready for a plan that puts your best interests first, visit victoryindependentplanning.com and schedule your VIP consultation.
On April 6, 1917, the United States officially enters World War I. This is about late arrivals, shifting roles, and joining the right battles. On April 6, 1917, after years of trying to stay out of a European conflict that had already chewed up millions of lives, the United States formally entered World War I. For nearly 3 years, Americans had watched the war from a distance. Presidents, politicians, and ordinary citizens argued about neutrality, trade, submarine attacks, where the country's true interests lay. The prevailing instinct was to stay on the sidelines, sell goods, lend money, but avoid sending sons to die in muddy trenches an ocean away. The pressure mounted. German U-boats began targeting neutral shipping. The infamous Zimmermann telegram revealed German plans to seek a military alliance with Mexico against the United States. The economic ties between the U.S. and the Allied powers grew deeper, and the idea that America could remain both profitable and untouched by the war became less and less realistic. On April 2nd, President Woodrow Wilson addressed Congress, declaring that the world must be made safe for democracy. 4 days later, Congress voted to declare war on Germany. The United States, late to the fight by European standards, pivoted from observer and supplier to active combatant. Now, the decision came with enormous consequences. The U.S. had to raise and train an army almost from scratch. They had to shift factories from civilian to military production, and they had to manage rationing and bond drives at home. The United States redefined its role on the global stage. For better or for worse, America emerged from the war as a creditor nation and a central player in world affairs. The cost in lives was real, but so was the long-term impact. The country could no longer pretend that sitting on the sidelines was always the safest or even the most profitable option when the world around it was on fire. For modern investors and retirees, April 6, 1917 is more than a diplomatic turning point. It's a reminder that staying out of every fight isn't always wise, that timing and preparation matter, and that once you join a battle, you need a clear sense of why you're there and what success really looks like. Here then are 4 lessons for the modern investor from the U.S. entry into World War I. Now, one obvious lesson is about delayed engagement. For years, the U.S. profited from neutrality, selling goods to warring nations, lending money, avoiding the immediate costs of battle. Now, many investors try a similar approach with markets, staying in cash until things calm down, air quoting, watching bull markets from the sidelines or waiting for the perfect entry point that, well, never quite appears. At some point, though, not participating becomes its own form of risk. Inflation eats away at your idle cash. Opportunities compound without you. The question is not whether you can avoid every conflict. It's whether you can afford to sit out of growth indefinitely while the rest of the world moves on. Like the U.S. learning it couldn't remain a distant shopkeeper forever, long-term investors eventually have to decide when to step in, recognizing that there is no perfectly safe, perfectly clear moment to do so. A second lesson comes from the way the U.S. had to retool its entire home front once it committed. Factories shifted from consumer goods to munitions. Farmers were urged to increase production. Households were asked to buy war bonds and change their consumption habits. The whole system had to be aligned with a new objective. In financial terms, once you decide to declare war on a retirement funding gap, a college goal, or a debt burden, it isn't enough to make a symbolic change. One new fund, one good quarter, probably not going to cut it. The budget, savings rate, investment mix, tax strategy, and even family conversations about money need to support the mission. A portfolio can't fight a war that the rest of your financial life is quietly undermining. There's also a cautionary note here about overreach and unclear endgames. Wilson spoke in sweeping moral terms, which he often did, about remaking the world. But the post-war settlement was messy. The Treaty of Versailles, the League of Nations, and unresolved resentments helped plant the seeds of future conflict. In investing, grand visions like, I'll retire at 55 with more money than I'll ever need, or I'll always beat the market, well, they often collide with reality. Setting ambitious goals isn't the problem. Setting ones that ignore volatility, human behavior, and changing circumstances, that is the problem. A better approach borrows from the more pragmatic military planners of the time. Define what success actually means. In our case, it's a sustainable withdrawal rate, a funded education plan, or a specific legacy. Know what you're willing to risk to achieve it, and accept that some outcomes are beyond your control. Finally, America's entry into World War I underscores the ongoing need to reassess your role as conditions change. Before 1914, the U.S. could plausibly imagine itself as a mostly regional power. By 1919, that story was gone. Trade flows, alliances, and responsibilities all were completely different. Similarly, your financial role will evolve. If you're a 30-year-old with a growing career, minimal dependents, and decades ahead, you can fight in ways that wouldn't make sense for a 70-year-old living on distributions. A business owner before a liquidity event will have a different risk profile than the same person 5 years after a sale. Thinking of yourself as permanently neutral or permanently aggressive misses the reality that your obligations and your leverage change over time. Here's a final thought this week. When Congress voted on April 6, 1917, there was no guarantee of quick victory or clean outcomes. The U.S. didn't enter the war because it suddenly became risk-free. It entered because the risks of non-involvement had grown too large, and because policymakers believed that shaping events from within would ultimately be better than watching them unfold from afar. Your financial life will never involve decisions on that scale, thankfully. But the underlying dynamic is similar. You can't avoid every market storm, every policy shift, or every geopolitical shock. You can decide consciously which battles are worth joining. A good plan doesn't promise that you'll never take losses. It aims to ensure that when history moves faster than you'd like, you're not left watching from the sidelines, wondering if you waited too long to get into the action.